If you could see into the future, what would it look like? This is Tonight. I'm Bruce Whitfield, and tonight we follow the money. We gauge how fund managers investing trillions see the future. Joining me, John Morris, strategist at Merrill, Lynch, South Africa, and Vestact's Sasha Naryshkine. You surveyed the fund managers. The fund managers have given you an overview of what the next 6 months look like. Summarise, John.
So they think cash is king. They like offshore assets. And then within equities, it's banks, general miners, and oil. So it's a fairly defensive portfolio. And I would say on balance, they're looking at value and they're looking for a portfolio that will benefit from rising bond yields going forward.
Absolutely nothing unexpected then. I mean, that's what the trends of the market are. That's the sense we're getting from the fund managers. Are any of them being a little bit more adventurous? Any doing what, I don't know, what Momentum's Value Fund did and take a 10% stake into the portfolio in African Bank, for example? Are there any outliers, or is everybody kind of on the same path?
Well, it's a consensus survey, so we don't have the outliers, but I would say that stock picking has become far more important in an environment where the macro is perhaps becoming less important. Stock correlations have fallen quite dramatically. So stock picking is key, looking for specific stock ideas.
Okay, I mean, stock picking is always important, Sasha. I mean, you base your life on that, don't you?
Exactly. But John's far cleverer than I am, and you're far cleverer than I am too, Bruce. But
yeah, I can't speak for John, but I certainly got an answer from you.
I find it a bit strange, having gone through the report, which is beautifully color-coded here in front of us, that people are, all bullish on commodities specifically, or resources. There's some legendary fund managers. Who's the guy from Legg Masons, Bill Miller? He ignored commodities because they were too cyclical. Interestingly, he loved financials and got caught with his pants down with Fannie and Freddie, and of course Bank of America before they joined Merrill Lynch as well, and Citi and all those, because he perceived them to be much cheaper than at the wrong time.
But that's the problem, isn't it? I mean, this report is great because it gives you an insight into perhaps a herd mentality, the consensus mentality that may exist in the market at the moment. And we like resources, and we like the sort of diversified miners because that's where the value is at the moment. But you can sit in value for years. Ask any value manager and get yourself really seriously burned.
You used herd and Merrill Lynch together. Very clever.
I'm all bullish.
Yes, herd mentality. I mean, obviously a job for a fund manager is to outperform the equities market. That's what they're paid for, right?
Yeah, absolutely.
It's simple enough. But if they underperform the index, I remember it was Wayne McCurry who once said, then I don't have a job in 18 months. Yeah. So, it's a tricky scenario, and I wouldn't want that for love or money. We speak to private individuals, so we're able to be a little bit more nimble, I guess, when chatting and allocating portfolios, because it's not a cookie cutter approach. But if you're allocating units to someone who's entering in today, also, I mean, remember, if you're Coronation, you've done superbly well, people will start throwing money at you and you'll get more and more, and suddenly your
allocating capital becomes a lot more difficult.
Trickier.
Absolutely right. But the macro, you say, is less important. And I wonder about that simply because what has driven markets so strongly for the last 5 years has been the macro. It's been the abundance of cheap money. I bought a paper copy of Fortune magazine just the other day. Sasha Naryshkine thinks that shows out the Luddite in me. But reading an interview with the Indian central banker, a guy who worked in banking in the United States, who says we're heading for another crash. Simply, interest rates too low for too long will cause us a dislocation in markets. Surely the macros are absolutely crucial right now.
Yes, so it's been critical since the global financial crisis. But as the global economy slowly gets back on its feet, then stock picking will become more important, and it won't just be macro and all about QE and excess capital and liquidity.
But for the next 6 months, what surprises me about this research, though, is people saying in the next 6 months macro is not important.
It'll always be important. Central bank's going to be important. We're all wondering what the ECB is going to do next, because Europe is slowing down and growth is slowing, and they're on a sort of deflation path. So that's, the Fed probably is way ahead of the curve in that they've had very aggressive policy. ECB still really needs to go along that path. So I think macro is still important, but the world growth is slowly improving, led by the USA. In Europe, it's slowing down. So it's still going to be important, But if you look at our global survey, and the survey we referred to earlier is the local survey, their managers expect value to do better than growth. Now, they would only say that if they felt that the US growth path was going to improve, that bond yields are ultimately going to go up, which is a sign of better, most probably better growth, more so than inflation. So when growth broadens out, earnings broaden out, and then you can look at a bigger range of equities rather than those ones that did well in the global financial crisis.
Okay. Sasha, I mean, you guys made a lot of money out of Facebook. You made a lot of money out of Apple, for example. The theme of going offshore is also, from a South African perspective, has been a popular theme for quite a long time. And the valuations do remain considerably more tempting outside than inside.
And remember, our equities market is not joined at the hip to our economy.
No.
In fact, the
Thank
complete
goodness it
opposite.
isn't. Thank
Exactly.
goodness it isn't.
You know, I mean,
Yeah.
many of the bigger businesses, and in fact, Bidvest announced with their recent results that maybe they were looking to float their international food services businesses. So you'll have more access to offshore businesses simply because, you know, the way Brian Joffe sees it, and he's been around for long enough. You know, there are a lot of problems here in South Africa with regards to allocating new capital. So
65% of his business remains here.
profits, not revenue.
Okay, so
about half.
Well, I mean, it's like Old Mutual. Isn't it? 65% of profits remain here as well. The great internationalization of South African companies hasn't been that fantastic in some respects, whereas the dependence has still remained on South Africa for the likes of Vestact and for the likes of Old Mutual, for example.
Yeah, but like Indian and Brazilian companies, you've got this funny little thing called exchange controls.
Yeah.
So it might have happened quicker. You know, maybe it would have been to the detriment of the local investors if people had looked offshore to those capital markets sooner in the cycle. But, you know, we've got still lots of options here.
Okay.
And whilst we have done well internationally, and you're right, some of the valuations look better, the margins in Bidvest's local business, it tells you that it's easier to do business here than against, you know, the likes of Cisco, which are also a food services producer.
There we go. So what do we do then, John? I mean, it's all well and good to have the research. It's all well and good to have the fund managers give us their view that value is the next trick in town, that you need to be looking at financials, which remain in South Africa quite nicely valued. A lot of resources counters. I mean, Impala's getting cheaper every day. You know, so where do we allocate our money as individuals looking at the research?
Well, I think offshore is still the place to go ultimately. If you look at the S&P valuations, we look at 16 measures, and only 4 say that the S&P is on the slightly expensive side. In fact, one is very expensive. That's the Schiller PE, which we would argue they're using a very low earnings number because they capture some of the recessionary earnings. So, you know, the S&P looks fairly valued, fairly even too cheap on some measures. So I think, you know, there's better returns offshore than South Africa returns. I think within South Africa, it's financials. And then ultimately, if you do get rising bond yields, that will be beneficial for resources. But we don't see a roaring resource bull market when we have forecasts for commodities ultimately tracking sideways.
But do we take, in the financial services sector, the running dog, which is FirstRand? Do we take Nedbank, which has got some interesting prospects? Or do we take Barclays Africa or Standard Bank that have been far more maligned in recent times and have struggled a bit?
Well, I think we would prefer FirstRand and
FirstRand. And what about insurers?
Insurers are quite defensive. So if there's a correction in markets, perhaps when the Fed starts talking more aggressively about a rate hike, you may see a correction. We would like to buy that correction. And insurance, you know, could be defensive on a correction like that, but they would also be affected by rising bond yields.
What's your favorite?
I think we'd go for banks.
You go for banks instead. Sasha?
My absolute favorite in the sector is Discovery.
Okay, I mean, Discovery hit $100, $102 the other day. Very strong trading update coming through.
Trading update, yeah. I mean, because it's a multifaceted business, you know, pushing quite strongly the Vitality product. That for us is key in terms of, you know, health and wellness is going to become a massive theme globally. So if you can make sure your core clientele doesn't claim, well, it's going to make for a much more profitable business. By incentivizing them with silly things like driving against your mate who sits across the desk. I got engaged in that.
And who's winning?
Me, I'm like Miss Daisy.
Okay, brilliant. I mean, but it is those silly games. I mean, you download the Discovery app, you drive, it tells you you're driving like an idiot. So what you do as a good upstanding citizen, you try and drive better. And the moment it affects a change in behavior, it affects profitability of the business. You like Discovery?
Of course.
Of course, but he didn't pick it. Give me a sense of resources then. I mean, at one time, you guys were big bulls on Impala.
We did. We sold it probably about 80 odd rand ago. Simply not for any, yeah. I mean, we didn't expect the labour situation to deteriorate so quickly. So the problem is, I cursed that City report that said X-Energy, South Africa is the richest country in the world. You remember?
Yeah.
I think it's 2011 or... So the ANC Youth League got their hands on that and said, hey, let's nationalise these mines. Let's all get fabulously wealthy. But if it costs 2.7 trillion to get out the ground, well, then you might as well leave it there. So the problem is they're facing too many headwinds. So don't ask me where the bottom is, Bruce, but for the time being...
Are you staying clear of resources?
No, we do own BHP Billiton and Sasol. Energy we're a lot more positive on.
There we go. Energy, I mean, is Sasol a good global play?
It is expensive versus global plays, but it's a favourite with the locals because it is a rand hedge. It's a good rand hedge.
For so many people, I mean, for people who've got 10,000 rand a month to invest, they're not going to go through the Reserve Bank process of offshoring their funds and all of that sort of stuff. Is it okay to buy local, go look at South African companies doing business overseas, looking at the Bidvest? That's got to be the strategy for South Africa.
I think that's very important because South Africa GDP is very slow.
Yeah.
And subpar. So you keep on looking for companies that are expanding abroad.
There we go.
And in fact, at the moment, they're trading at a 40% premium, offshore stocks to domestic stocks. And for that very reason.
Is that premium justified?
I think it's justified for the growth, and you've got to be selective, of course, on what you choose.
What's your favourite, Sasha, on that?
Well, a point could be made for looking at the last 10 years, Aspen and Adcock Ingram. One had a chief executive that was, hungry to look for anywhere in the developing world, and Aspen shareholders has done fabulously well. Aspen trades on a 30 multiple. Yeah. Very expensive, but they seem to deliver the earnings time after time.
Do you still like it?
We still like it, even at 300 odd rand. I mean, whereas, Brian Joffe said maybe they made a little bit of a mistake with Adcock Ingram.
Yeah, who's looking at Adcock Ingram's results, of course, and comparing them to Grimm's fairy tales. John Morris, strategist at Merrill, Lynch, South Africa, and Vestact, Sasha Naryshkine. Thank you both for coming in, sharing those insights with us over the next 6 months. That's what the fund managers are thinking, and that's what these two bright guys are thinking as well in terms of markets. A nice guidance there as well. Thanks for watching. There'll be more tonight, tomorrow. Till then, good night and goodbye.